Can one fund be your entire portfolio? Now, most investors, especially high-income earners, make their portfolio really complicated, and it doesn't have to be. Now, today I'll show you how to create a sophisticated, well-diversified investment portfolio using just one fund. I'll show you 6 different single portfolio options, and I'll rank them from rank 6 all the way through rank 1. None of them is bad options. They're all basically good, better, and best. Hi, and welcome to the Money Matters MD Show. I'm your host, Dr. Abhishek Gadre. I'm a practicing physician, and I help high-income professionals like you take control of your money. Now, let's start with rank 6, which is an S&P 500 index fund or ETF. Now, Vanguard has an ETF called VOO, which is extremely popular. If you choose VOO as the single fund portfolio, you're basically buying into the 500 top companies listed in the US, and you're basically invested in a 100% equity portfolio, which would be a high risk portfolio in the accumulation phase. You have no bonds in this portfolio right now, and you're invested completely in the US. There is no international exposure, and there is no small caps either. This is all entirely large caps. Now, the expense ratio of VOO ETF is extremely low at 0.03%. Now, this was actually the very first index fund ever launched by Jack Bogle about 50 years ago when Vanguard was started back in 1976. And the corresponding VOO ETF right now is the largest ETF in the world, including the US. By the way, you're in good company here because Warren Buffett said that if he didn't want to manage stock picking actively, he would just pick a 90% S&P 500 fund and 10% short-term treasuries. And that's also called the Warren Buffett portfolio. Now, what you get at rank 5 is a total US stock market index fund or ETF. Now, VTSAX or the corresponding VTI ETF, both from Vanguard, are excellent investment options. Now, they're a little bit more diversified than VOO. They're basically investing in the entire US stock market instead of just the top 500 companies. It's investing in the 4,000 US companies, regardless of size. So a total US stock market basically also gives you exposure to mid cap and small cap in addition to large caps. Now, if you look at the behavior of VTI and VOO, they behave essentially identically, but I would still suggest that VTI is slightly better than VOO because it's more diversified. The VTSAX index fund, which is actually the largest index fund in the world right now, and this was one of the favorite funds of Vanguard's founder, Jack Bogle. He would often say, don't look for the needle, just buy the entire haystack. Now, if you own this fund, you can own stocks inside it like Nvidia right from the IPO all the way to the time they are now the biggest stocks in the entire index. There's actually a beautiful book written by J.L. Collins. It's The Simple Path to Wealth, and I absolutely love that book. And he describes it so eloquently and simply that you really don't need to hold anything other than VTSAX as your entire portfolio. Now, if you're interested in reading this book, I'll leave an affiliate link down below in the description. Now, mind you, it is an affiliate link. I do get a tiny commission. It does support the channel, and it allows me to bring good quality content to you. So thank you for supporting the channel, and use that link if you're going to buy this book. Now, rank 4 is a total world index fund, which would be VT ETF, or they have a corresponding index fund called VTWAX. Now, the expense ratios on this are also quite low. They are 0.06% for the VT ETF. And what you're basically getting is a total world index. So you're not just invested in the US, you're also investing in the 3,000 to 4,000 companies outside the US. There's actually a total international index fund called VXUS from Vanguard, which alone by itself, I wouldn't advise that as a single fund portfolio. But if you were to add VTI and VXUS together, effectively that becomes equal to a VT ETF. And we're talking about single portfolios right now. So a VT ETF effectively would diversify you in all the equities across the entire investable world index. Now, remember that the international equities and US equities take turns, and there's a lot of recency bias in most portfolios right now. For the last 15 years, the US equities have done ridiculously well. Now, that outperformance may not last your entire lifetime, and I would strongly advise to include some amount of international equities. One, just to hedge against the US dollar and have some unhedged non-dollar currency exposure, and also to have some equity exposure outside the US. And Vanguard actually recommends about 20 to 40% of equity exposure outside the US or ex-US, which VT ETF will totally give you within just one fund. Now, there's another interesting book that I read a few years ago. It was called How I Invest My Money. Now, this book is actually an interview format book, which interviews a lot of major hedge fund managers in which they reveal their own personal portfolios and what they hold in their retirement accounts. And interestingly enough, the VT ETF was one of the most popular ETFs I noticed in this particular book. Now, if you want to read this book, again, I'll leave an affiliate link down below in the description. Now, of course, these hedge fund managers can make their portfolio really complicated, but a lot of them want simplicity and just buy the VT ETF for their entire equity holding. Now, rank 3 is a balanced fund. This is the first one where you're actually seeing some bonds. So this is basically a 60-40 portfolio between stocks and bonds. And this is completely US focused. So it basically invests you 60% VOO and 40% within BND. So the expense ratio of the VBIAX index fund is around 0.07%. This is a moderately aggressive fund. Now that we're starting to introduce bonds, I would put these type of investments more in a tax sheltered account like your 401k or IRAs, not in your taxable investment accounts. Now, if you're planning to invest within a taxable brokerage account, I would stick to rank 4, which is the VT ETF as your top investment. Now, I already know I'm going to get a lot of hate from a lot of viewers in the comments section for recommending bonds. But now, if I knew nothing else about you, I didn't know if you're 20 years old or 90 years old, and if we're in the middle of a bull market, or if this is a massive recession or market correction, regardless of economic cycle, a 60-40 portfolio is a nicely diversified single fund portfolio holding, which pretty much anybody can hold. And now, if you're in retirement, you're 70 or 80 years old, and you're actually spending down your portfolio, I don't think having a 100% equity-based portfolio is a good idea. Now, I know Dave Ramsey will disagree, but that's fine. We can just agree to disagree on that. Now, over the last 100 years of investing, the different investment vehicles have had an interesting journey and evolution. We started with actively managed mutual funds, and then went into index funds, and then ETFs, and now we're talking about actively managed ETFs. I find this really fascinating, and I actually made a whole separate video talking just about this, and I'll attach it right here. Now, rank 2 are Vanguard's LifeStrategy funds. Now, these are basically balanced investments which invest into 4 underlying assets: US equities, international equities, US bonds, and international bonds. Now, they basically have a whole spectrum of investment within the LifeStrategy funds. Now, you could start with an 80-20 allocation with 80% stocks and 20% bonds, and that's the VASGX fund, which is their growth fund. The expense ratio is around 0.14%. Now, mind you, you're getting a completely diversified 4-fund portfolio for this, and you don't have to do too much work. There is no rebalancing. You're just buying into one fund, and it basically essentially gives you a globally diversified balanced portfolio of stocks and bonds. And I think this is an excellent investment as long as you know what your asset allocation needs to be. Now, if you want to be a little bit more conservative, you want 60-40 globally diversified, you could look into the moderate growth LifeStrategy fund, which is VSMGX, which is an expense ratio of 0.13, and it goes more conservative as well. You could do 40-60, which is VSCGX. This would be for a complete, somebody in retirement. They are just focusing on wealth preservation. They're not really focusing on growth at this point at all. This would be a very conservative fund. And in the end is VASIX, which is a income fund only, which is a 80% bond fund and 20% stock only fund, which is extremely, extremely conservative. But again, you can come up with your own asset allocation depending on your age and investment time horizon and how far away you're from retirement. Now, as long as you want to stay in a fixed asset allocation, you could just pick a LifeStrategy fund and make that your entire portfolio. So the LifeStrategy funds are actually globally diversified funds, and they bring in globally diversified equities and bond holdings all just in one fund, and it's all for dirt cheap and auto rebalancing. Now, this is pretty much what the Bogle hedge philosophy is all about. These are Jack Bogle's followers. They believe in low cost and index fund based diversified portfolio investment. And I think that's an excellent set of basic principles to go by. Now, one quick little thing before we move on. A lot of you viewers right now are not my subscribers. I would highly appreciate it if you subscribe to my channel and like this video. That's how the YouTube algorithm knows that I'm making good quality videos, so it can show more of my videos to viewers just like you. And just so you remember, this is not financial advice, this is for educational purposes only. Now, rank 1, if someone is to put a gun to my head and said, you're gonna die tomorrow, and the last thing you can do before you die is pick one fund, and I don't want my wife to deal with all the complexity, what is that one fund that I'll pick for her to put all my money inside of? Here you go. Rank 1 is something called target date funds. Now, if you're aware of it or you're not, you're probably invested in a target date fund within your 401k, which you get from your employer. So basically what a target date fund is a diversified investment which is balanced between stocks and bonds, and it becomes progressively more conservative as you get older. So it follows basically what's known as a glide path, and I'll show you what a glide path looks like. So as you can see, when you're in your early accumulation phase, this is the glide path from Vanguard, by the way. Our glide paths from different investment firms look a little bit different. So Vanguard basically starts you at 90% equities, 10% bonds. So when you're younger, let's say you're about 20 years old or 30 or even 40 years old, you're just in 10% bonds and 90% equities. And as you start getting older, by the time you're 60 years old, it's basically putting you in a 60-40 portfolio by that time, 60% equities and 40% bonds. And these are all internationally diversified. You're getting US equities and international equities, and you're also getting US bonds and international bonds all within the same fund. And it gets progressively more conservative, as you can see, by age 65. Let's say that's your target age for retirement. By that time, you're effectively 50% in equities and 50% in bonds, and it starts buying some TIPS, which is Treasury Inflation Protected Securities. And by the time you're 72, it's basically extremely conservative income only type fund. It's only 30% equities and 70% in fixed income. And it basically holds that through your entire retirement period. Now, all you need to do to pick the correct target date fund is basically choose the year that you're going to retire in, and the rest is taken care of by the underlying glide path. Now, you can get a financial advisor and get a managed portfolio, and they would charge you 1% asset under management fee to do exactly the same, to make it a little bit more conservative as you move towards retirement. Or you could do it entirely free, just buying into one of these target date funds. Now, a lot of these target date funds are labeled by the year that your target retirement is in, like 2030, 2035, or 2040. Now, if your target retirement is in 2040 and you want a little bit more aggressive fund than that, you can just buy the 2045 fund instead of 2040. So basically what you will do is get a little bit more exposure to equities than bonds. And if you want a little bit more conservative fund, you could pick 2035 if you wanted to, and you will get more exposure to bonds than equities. Now, mind you, that target date funds are excellent investments, but I would only keep them inside of a tax sheltered account. I wouldn't pick this in your taxable account because there's a lot of bonds in here as well, and you're just basically getting more and more into bonds as you get older. Now, if you learned something useful today, please subscribe to my channel and like my video. Thank you for watching. Money Matters MD, over and out.